Greetings, accounting students. Today I'm going to introduce the fundamentals of double entry recording in accounting. Now, there's two fundamental principles that underpin double entry recording. Principle number one, every transaction has at least a twofold effect on the accounting equation, assets equals liabilities plus owner's equity. And the second principle, we link this to the balance sheet because we've got the assets on the debit side and they will always equal, after every transaction, the liabilities and the owner's equity on the credit side. So some key terminology here, debits and credits. Debit entries in dollar terms will always have a matching credit entry in dollar terms. And we need to link this back to the balance sheet. Again, this is the assets side of the balance sheet. This is the liabilities and owner's equity side of the balance sheet. So when our asset goes up, we're going to do a debit entry. When our liability and owner's equity goes up, we'll do a credit entry. And when the opposite happens, when we get a decrease in a liability or owner's equity, we'll do the opposite to the credit, we'll do the debit. And when we get a decrease in an asset, then we'll get the opposite to what we do with increasing assets. That will be a credit entry. So when we do double entry recording, we utilize ledger accounts. A ledger is an individual account used in a double entry recording system. And so we'll need to create a ledger for every single account we have. When we refer to the general ledger, that's simply the plural term that refers to all of our ledger accounts. So when we're asked to post our journal information to the general ledger, that just means we need to post these to all of the relevant ledger accounts affected, both in terms of our debits and our credits. 4 key ledger recording rules. Just remember, the asset side of the ledger, we call that the debit side, and the liabilities and owner's equity side, we call that the credit side. Rule 1, every transaction affects at least 2 ledger accounts. Rule 2, every transaction has an equal debit and credit effect in terms of dollars. And rule 3, after every single transaction, A will always equal L plus OE, and the balance sheet will balance. The assets will equal the claims on the assets, both internal in terms of the owner's equity and external in terms of the liability. And a 4th rule, the hardest one to remember, is when do we debit and when do we credit? So when we have an increase in assets or expenses, that will be a debit entry to that ledger. And when we have the opposite, we'll do a credit entry. Debits and credits are opposites. So therefore, when we have an increase in revenue, owner's equity or liabilities, we'll do a credit entry. And when we have a decrease in any of those, we'll do the opposite, which is a debit entry. Okay, so as is the case with Newton's third law of motion, every debit entry has an equal and opposite credit entry. And so what we need to do is we need to perform what we call cross-referencing in our general ledger. And we do this to verify the accuracy of our double entry recording. And so when we have a debit entry, we're going to cross-reference that with the ledger that we do the corresponding credit entry in, and vice versa. Let me illustrate. So we've got a transaction here. An entity has purchased $5,000 worth of inventory for cash. Let's ignore the GST to keep things nice and simple. So the first thing we need to do is work out the 2 accounts affected, the 2 ledgers. Obviously, one is inventory, and we've got less money in the bank. So therefore, our first account, inventory, has increased, more inventory on hand, and our rules of double entry are that when we have an increase in an asset, that's a debit entry. The second account affected is our bank balance. We've got less cash. And when we have an asset decreasing, we have a credit entry. So we've got a debit and a credit entry there, 5K each, debits equal credits. So then we need to cross-reference these as follows. So in our inventory account, we've got $5,000, assets going up, and so we simply just cross-reference that with the other account affected, the bank. And in our bank account, we've got a credit entry for 5K because our bank balance is going down, so we just cross-reference that with the other account affected. So if we look at these two accounts, inventory, how do we fund it? From the bank. If we look at our bank account, where did that 5K go? It went to inventory. All right, so let's have a look at another example, and we're going to take this step by step. So we've got the owner has contributed $2,000 worth of cash, and we have to post that to the general ledger, plural for ledger accounts. Step one, we work out the two ledger accounts affected. So whenever we have a cash transaction, one of the accounts will be bank. And where has that cash come from? It's come from the owner. So because of the entity assumption, the other account affected is our capital. Then we work out if these two accounts are increasing or decreasing in terms of their balance. So our bank balance is increasing because the owners pumped some money into the bank. And our capital account has also increased because the contribution has increased the residual claims on the assets. Step three, then we work out our double entry rules to work out which is our debit and which is our credit. And we know that when we have an increase in an asset, that's a debit. And we know that when we have an increase on the other side of the balance sheet, the owner's equity, that's our credit. So just remember, in terms of our ledger recording, we've got to have a cross-reference, we need a date, and we need an amount. So in terms of our two ledger accounts, we've got the asset bank going up. We cross-reference it in terms of, well, where did those funds come from? They came from the capital. And in terms of the increase in our capital, what was the contribution by the owner? The other account affected was our bank. Let's bring GST into the mix. I said before that every transaction will have at least a twofold effect. So when we throw GST in the equation, we'll have an odd number of accounts affected. So here we've got the owner has purchased some inventory on credit. So therefore that's impacting our inventory account. We've got a GST effect, and because it's on credit, we've created an account payable, which is a liability. So therefore, in terms of the rules of double entry recording, inventory is an asset that's increasing. We only increase that by the value of the inventory, not the GST. So that's a debit entry. Our GST has actually decreased because when we have a GST payment or we're charged GST for a purchase, that actually offsets the GST that we owe to the ATO. So that's actually a reduction in our GST liability to the ATO. So that's a debit entry. If we add the two of these up, that's how much we owe to the accounts payable, which is also a liability. So our credit terms are to pay off office works, presumably in 30 days, for the total amount, the combined $300 for the inventory plus the GST that's attached to that. One final thing to consider is opening balances. So when we have an existing business that has assets on hand and the consequential claims on those assets, we'll need to have these opening balances feature in our general ledger. So for the three assets here, we'll need to record these on the debit side of the ledger. And for these liabilities and the owner's equity, these will feature on the credit side of the general ledger. So to keep things brief, I've made a bit of a mess here, but anyway, we've got our assets on the debit side. They've been posted to the debit side of the general ledger. And we've got our liabilities and owner's equity on the credit side of the balance, so they've featured on the credit side of our general ledger.